Aram, you can start.
Sir, let's start. It's already 11:08.
Yes, sir. Give me 2 minutes only.
No problem, no problem,
Aram
sir.
is starting. Yeah.
Okay. People who have joined will be waiting.
Yeah, sure. Just give me 2 minutes. Aram, you
No
can
problem.
start. Yeah.
Even the smallest change in perspective can bring about the greatest changes around you. A very good morning to all the resource persons, coordinators, teachers, and participants. Today, Department of Commerce MAIMS is organizing a webinar on financial literacy opportunities in capital market. The objective of this webinar is to create awareness among students about various investment avenues available in the capital market. The webinar will help the students to learn about the techniques of wealth creation. I feel honored to introduce Mr. Vineet Singh Kaler. He is postgraduate in planning and entrepreneurship with over 16 years of experience in financial market, treasury options, risk management, and exchange industry. Mr. Kaler is currently working as Senior Manager, Training and Education, MCX. In his current profile, he shares his knowledge and expertise in treasury options, risk management, market research, and strategizing using derivatives with market participants in the realm of commodity and currency segment.
Hello. We are connected, sir.
Yes, sir.
Okay.
Yeah.
So can I start now?
Yes, sir. You can start.
Okay. Good morning, everyone. Good morning, students and faculty member and management of the institute who have given us this opportunity to interact with all of you. Today we'll, under this World Investor Week, which is coming from the regulator side, we'll try and engage all of you to understand dynamics of this commodity derivatives market and make you more aware of, what all our opportunities are available, how market behaves, what dynamics are there. So let us just start with the presentation. I request you all to please be muted and keep typing your queries in the chat box so that we could take them one by one towards the end of session. I'll try to wrap up this session within 45 to 50 minutes, and then 10-15 minutes we'll take the Q&A. Till that time, don't keep your queries to yourself. Keep typing them in the chat box. So, towards the end, I'll take all of them one by one. So we start. I am representing one of the financial institutions of the exchange, which is of the market, which is MCX, Multi Commodity Exchange of India. We are one of the commodity derivatives exchanges. Uh, and as per the financial markets, the setup which is there in front of you, usually we are aware of capital markets wherein debt and equity, even equity uh, derivatives as well as spot trading happens. Debt market where loan mortgage instruments are traded, and then interest rate derivatives are also available. Then we have forex market where currency and currency derivatives, currency pairs are traded and the derivatives are also traded. Likewise, in the same financial markets, we have commodity as an asset class, wherein commodity physical market is big market prevalent, as well as commodity derivative exchanges are also working, um, wherein a lot of participation comes from market participants which are across the globe. Okay, this market is a global market. So this kind of a setup of financial markets you will see everywhere in the world. Now, what is this market all about? As the name suggests, commodities, it is a product-based market. Okay. Now, what kind of product? Commodities are basic raw materials wherein which forms the first point of value chain. These are basic raw materials. When we talk about basic raw materials, that means using the basic product, a lot of value additions are done, and those products in terms of finished goods are then utilized and consumed by industry at large. This commodity market, it covers around 91% of the world economic activity. You just think of any example, any industry, any type, say, automobile industry, telecommunications industry, electricals and electronics industry, apparel industry, construction and cement industry. Just name an industry. The commodity as a raw material will be utilized, and a lot of value additions would have been done to create the finished product. It is only service industry across the world which is not directly linked to commodities. Otherwise, around 91% of the world economy is revolving around this asset class, commodity as an asset class. So there is a interesting fact to know that commodity market on a daily basis, it trades into trillions of dollars. When I say trillions of dollars, I want to say that the trades which are happening for products. See, it is nothing a new concept for market participants. Commodity trading started with a very old form of trade, which was barter system, wherein people used to trade for goods to goods. Then it was taken up by money as a medium of exchange, and since then a lot of developments have happened. A lot of trade volumes have been happening across the world for products wherein one country is having a deficiency and other countries are ready to supply. So likewise, India is one of the largest exporters of, say, cotton, sugar to the rest part of the world. At the same time, we import a lot of crude oil as a product. Okay. So what I want to bring in here is, I want to tell you that this market is not an old market, not a new market. It's a very, very old market. Plus, it is a product-based market wherein the products have been traded for a long time, centuries now, for exchange of money. Okay. So uh, this commodity derivative market is a parallel market to the physical commodity market. In other markets, equities, debt, for a little bit of forex, you will not find physical products being traded. But in commodities, a lot of physical products you will find being traded in product markets. When I say product markets, what do I mean is that suppose if I want to buy 10 grams of gold, where do I go and buy? I go and buy with the nearest jeweler. That is a physical market wherein you buy the product, pay the money. Such types of setups, wholesale markets, retail markets, semi-wholesale markets are prevalent in all cities and states across India, and for that matter across the world, where products are traded. Now, people who are engaged in this physical product buying, selling, manufacturing, processing, trading, what they face is that the availability of these products, that is product availability and consumption, are not always same. They keep on changing, and because of this change, a lot of price volatility is observed in the value of these products. And this price volatility is observed from various global factors, which range from demand and supply, availability of product, consumption of products, the way economies are behaving and how they are growing and they are requiring product consumption happening, the import and export restrictions or easing out of these restrictions, implement of more taxes to trade in international market, trade war situations which were there between US and China, global pandemic situations like COVID-19, wherein for a while economic activities across the world have been stopped, and we are still recovering from that phase to reach the normal demand. War-like situation between Ukraine and Russia, which is currently happening for over 7 months now. So because of all these things, and dollar reaching its lifetime high, dollar it's appreciating big time because of changes in the interest rate. So all these things somewhere boil down to its impact on commodity prices, right? So commodity fundamentals, or the reasons by which commodity prices are moving, are of global nature. Okay. Plus commodity also gets an impact from the other asset classes like currency market, interest rate markets. So these markets are well interlinked with each other. Now, what is the advantage of having these markets interlinked and available simultaneously is, if yourself considers to be, working with a fund house as a fund manager or a portfolio manager, now there you will require to have all asset classes which somehow be negatively correlated to each other, so that if one asset segment is not performing, the other asset segments could give you a better return. So this is where commodity has a greater advantage. Usually commodities and its values does not become zero, and it has a negative correlation to low correlation with forex market, debt market, and for that matter, even equity markets. So it becomes an excellent asset class of choice for portfolio managers across the world to choose this and trade as an investment vehicle in their strategizing and making of portfolio. Now, what are these commodities? I told you it is a basic raw material used to create other finished products. Okay. This commodity segment is broadly classified into 4 areas, that is agricultural segment, base metals, energy, and bullion. Agricultural segment, as name suggests, includes all agricultural products across the world, which could be clubbed into this segment, and derivatives on them are traded. Base metals include the industrial metals like aluminium, copper, lead, nickel, zinc. These metals, they have heavy usage and consumption in mostly all the segments and sectors of the economy. Energy segment includes products like coal, crude oil, natural gas. Bullion segment includes products like gold, silver, platinum, palladium, diamond. So these segments are same available across the world. Across the world, apart from physical markets, we have big derivative exchanges. There are around 86 exchanges in the world, and MCX being one of them. Okay, so on all the exchanges, you'll find these segments available. And for over a decade and a half, we have seen this fifth segment also emerging largely, that is intangibles. You'll find products like weather derivatives and temperature being traded in these markets. On derivative side, you will find even freight derivatives are also traded in many of the exchanges. You'll also find products like electricity also traded in many of the exchanges. And for that matter, interesting fact is we already have a electricity spot exchange in India which is running for power distribution and consumption companies to come and trade on. Very soon you'll find derivatives on, electricity also to be seen on the exchange. But the point is, these all are segments of commodities wherein products are bought and sold. They are basic products which are used for creating the value added products later on. These products, they are fungible and have no quality difference across the board. When I say fungibility and homogeneous, if suppose I give you 1 kg of gold of 24 carats and I buy from you after 6 months, that gold of 24 carats will have same value, same content, same quality. The quality will not change over a period of time. So these products are fungible and across the board, across markets. Okay, and usually these products could also be clubbed into two segments, that is a soft commodity and hard commodities, wherein hard commodity are products which are taken out from the earth crust, digged from the earth crust, like base metals, crude oil, coal, gold, silver. These are all digged from the mines and then taken out. So these are called as hard commodities, whereas agricultural products which are grown are called as soft commodities. So commodity markets in physical stature are huge, prevalent everywhere in the world, plus commodity derivatives are also there. So commodity market prices, they get impacted by any factor which moves the demand and supply equilibrium, and any other factors from related asset classes like exchange rate, interest rates, pandemic kind of a situation, special factors like weather, rainfall, like these, many factors, they impact the product prices across the market. Since these markets are in terms of financial instruments on the exchanges, we have regulators to keep a check on what is happening in the market so that no manipulation and trades are happening in a smoother and orderly format. So that is where this commodity derivative markets in India is currently regulated by SEBI, Securities and Exchange Board of India. This commodity derivative markets were allowed to be reintroduced with commodity derivatives in 2003-4. This is where MCX started its operation. It's been now 19 years, and we are 7th largest exchange in the world for commodity volumes in trading, right? This market is evolving still. We are not completely developed what we see equity market as of now in India or currency markets. We are developing in terms of products, in terms of participations being allowed. And when this kind of an evolve happens, a lot of career opportunities for industry people who are already working, and for freshers, it comes from time and again from different value chain partners across the board. Okay, so when SEBI, we started with trading in 2003-4, when FMC, Forward Market Commission, was the regulator. SEBI became regulator of this market in 2015, September 28. And since then, when SEBI has taken over, SEBI being a common regulator for currency, commodity, and equity derivatives, so a lot of changes have happened in the market setup. We are now integrated in market intermediary setup. We are in a universal exchange wherein any exchange can have multiple asset classes to offer, like international exchanges. And since then, many new products have been introduced so that market participants can participate in a lowest and most effective manner, like options were introduced in 2017. Index derivatives in commodities were also introduced in 2020, and time and again these are happening. Participant bank subsidiaries were introduced, smaller hedge funds, eligible foreign entities were given approval, portfolio management and mutual funds were given approval, and very recently, a month ago, foreign portfolio investors have been given approval. So participant wise, this market is getting more nurtured, product wise also it's getting more nurtured, and once this development happens, you will see multifold growth in this area, and when this happens, a lot of career opportunities for all of us will arise. Okay, now, to give you an impression now how global markets and we are, global commodity derivative markets is a second largest asset class in the world, wherein currency is the largest, followed by commodities. In India, still the largest asset class is equities, followed by currencies, interest rates, and commodities. So commodity is developing here, and it will reach the stature of international stands. In India also, it will become the second largest asset class. And for that to happen, a lot of developments are happening and will further happen in this area. Now, when we trade on a commodity exchange, we don't trade on physical products. That is very important to understand. For physical products trading, we already have physical markets. We have mandis, we have retail setups, semi-retail setups. Even you can buy and sell products online also. These are also physical type of physical markets, wherein product is bought or sold by paying money and receiving the product value. Okay. So those market setups are also running. But along with that, these commodity derivative segment is a complementary market, which is, or a, I would say, another market which is running, which is a derivative on commodity. So the question arises, what is traded on these commodity exchanges? Around 86 across the world. What is traded? The answer is we trade in commodity contracts. These are called as derivatives. These are called as standardized commodity contracts which are traded. And only two kinds of derivatives which could be standardized are futures and options, which are traded on these exchanges. Now, what are these futures and options? These are financial instruments who gets their value from the underlying product. So if these are commodity futures and options, the underlying will be a physical commodity. So if I talk about gold futures, the underlying is physical gold in the market. If I'm talking about crude oil futures, the underlying is crude oil as a product in the market. So this instrument will get its value from the underlying which it is representing. Now, the question is, why do we require these markets when already physical markets are running? Why do we require derivative market or exchange traded derivatives? The answer is in two forms. One is, by having derivative markets in commodities, we get efficient price discovered by everyone connected on the trading screen at a single point in time. Physical markets are segregated, no doubt. Quality products are traded in all the cities and states in all different segments of physical market, but they are not connected to each other on a single national platform. So once these commodity derivatives online systems are in place, they connect everyone from Kashmir to Kanyakumari, from most east part of India to the west part of India, central India. Everyone in India gets connected to this online platform. And when everybody is connected and they give their bids to buy and sell, and when a trade happens, a trader agrees to the opposite quote on the exchange, a trade happens, and this trade would be the benchmark price, single price across Indian market, for that matter, for MCX as an exchange right now. And if it is a global exchange, people coming there in huge volumes and trading is happening, a huge number of people, traders are prevalent. So a trade which would happen on that exchange becomes a benchmark price for rest of the world. So this is how prices are discovered on these platforms by market participants, and these prices becomes a unique price for complete market. Now, if you go to a jeweler and you ask him, Bhaiya, what is the price of gold today? So what he will do is, he knows the physical market price, but he will open the MCX screen and see the price and then do some calculation, premium and discount, whatever is the calculation, and then he will quote a price to you. Now, the point of matter is the first price reference, what he also saw was from MCX. Why? Because he knew across India, people are connected to this screen, and whatever trade price happens on this online market is the best price for complete India. So this is where the utility comes in. People, they discover prices in the commodity derivative exchange, wherein all market participants are connected simultaneously. And the other is it helps in managing risk. Commodity derivatives, they help people who deal in physical products to manage risk. Say, for example, there is a jeweler who is dealing in buying of gold, converting that gold into jewelry. Now, gold prices are not same. Because of international global movement, gold prices are very, very fluctuative. So this jeweler is faced with a problem that at what price can I buy my gold? And when I buy my gold at a certain price and I make jewelry out of it, my jewelry will not be sold immediately. It might take 3 months, 4 months, 1 year to sell that jewelry. And during this period, what if the gold prices falls? I bought a gold price at X price. What if when my jewelry is sold, the prices are coming down? Likewise, different people or players in the value chain who deal with physical products, they face this risk of physical commodity prices going up and down. Now, these price movement, nobody can control because they depend on international demand and supply and other fundamental factors. So what people in physical markets do is to get protection against this price volatility of the underlying products and to be profitable, they use derivatives on these commodity exchanges to manage their risk. So this is where the other utility comes in. So these are two main pillars of a commodity exchange. Why they exist is so that people could discover the prices connecting on a single platform, and the other is they can utilize this platform to manage risk. Okay, so the market setups looks like this. We have spot market wherein you can buy and sell physical products. Okay, by exchange, by transferring money from buyer to seller. And also we have derivative exchanges and markets whereby buying and selling of financial instrument is happening, which represents the same products. So for example, in spot market, the example would be a jeweler wherein I can go and buy the gold how much I want at the current price and I pay the money. Whereas in a derivative segment, I will buy and sell instrument derivatives on gold, and that is the same product which is dealt in the spot market. So when both market coexist, it gives an opportunity for physical market players to come and manage risk using derivatives, which are instrument getting the value from the same product in which spot market players are trading. So what is a derivative? A derivative is a financial instrument who gets its value from the underlying. So if it is a gold derivative, so its value will be around what is gold being traded in the physical market. Base is that. Okay, so its value will be around 50,000 per 10 gram or 51,000. But if it is a crude oil derivative, it's again a financial instrument, but underlying differs. It is the crude oil. So crude oil is right now trading around, say, 7,200 per barrel level. So accordingly, the value of derivative will differ from a gold derivative. So it is a financial instrument who represents the value of the underlying which it is representing. Derivatives are of four types: forwards, futures, options, and swaps. Now, forwards, options, and swaps are derivatives which could be traded one-on-one. These are negotiable instruments, okay, which when are traded, the contract terms, the and delivery schedule and other trading terms have to be finalized between the buyers and sellers mutually. Okay, these are privately negotiated contracts. So such kind of privately negotiated contracts are not allowed on the exchange. What is allowed on the exchange, derivative exchange, are standardized products. So futures as a derivative and standardized option are allowed on any derivative exchange. Now, when I say standardized, it means the terms of contract, trading terms, delivery terms, quality terms, they are all standardized, fixed by the exchange, approved by the regulator, and then all market participants can perform their buying and selling and trading activity on these products. Market participants cannot change the terms of these contract. So that is where these are standardized products. So once products are standardized and are traded on the exchange where these products are approved by the regulator, counterparty default risk and drawbacks of one-to-one trading does not anytime exist on the exchange. Okay, exchange guarantees all the trades which are happening. So there are different participants which are there on the commodity front, and these participants are not final. More participants are being added from time and again in a phased manner by the regulator to make this market more robust and developed. Recent addition to this was a month ago, foreign portfolio investors were allowed to come and participate in domestic commodity markets. Okay. Since commodity derivatives are global products, they trade with an extended working hour on the exchange. Trading on commodity derivatives in India is happening from 9 o'clock in the morning till 11:30 in the night and 11:55 in winters. Whereas if you compare it with equities and currencies, equity markets close its operation at 3:30, currency closes it at 5 o'clock, but commodity market works until late night. So that with international prices on the same products, domestic prices are also aligned. Okay. Agricultural products, some of them with local price reference, their derivatives trade from 9 to 5. Agricultural products which have international reference coming from global exchanges, they trade from 9 to 9 on the exchange. Say, for example, cotton, crude palm oil, they trade from 9 to 9, 12 hours trading. Product like bullion coming into these seven bullion metals energy like gold, silver, platinum, palladium, copper, nickel, aluminium, energy side, crude oil, natural gas, they trade from 9 o'clock in the morning till 11:30 in summers and 11:55 in winters. This is a kind of screen where live trading happens. You know, since today is Saturday, I cannot open the live market and show it to you. Maybe we can have a separate session sometime later, wherein I would love to show you the live screen and how the market prices they fluctuate. Okay, but this is a kind of screen wherein all trade happens in the market. Okay, all trading, hedging, speculating. This is a screen where all trading activity takes place. Now, when we deal in commodity derivatives, there is a big ecosystem which keeps on working. One is the front end, exchange front end, wherein all physical players like farmer, cooperatives, farmer operatives, wholesalers, importers, exporters, processor, traders, retail traders, investors, portfolio managers, arbitragers, fundamental traders, technical traders, they all use this platform to trade. Plus, since these are commodity derivatives on expiry, these are derivatives which have an expiry date always. So on expiry of derivatives, if the contract says these derivatives could result into delivery of product as well. Say, for example, if it is a gold as a derivative. So it is there in the contract written that it is a compulsory delivered contract. That means you can enter and exit many number of times during the lifetime of this contract. But if you have open positions on expiry time, those positions will be compulsorily marked for delivery. Buyers of, say, for example, gold contract, they have not squared off their positions. They are still having an open position till the last expiry minute. So they will be marked delivery by the exchange clearing corporation, and they have to take the possession of the holding of gold which they have as an open position, and they have to pay full money. They cannot say no. Even the delivery is marked to the seller, who cannot say no. It's a mandate once delivery is marked, and they have to bring in the same quality of product as mentioned in the contract specification and deliver to the buyers. So this ecosystem of delivery and maintaining the quality, traders can keep their products in the warehouses, is also a big ecosystem which runs on the back end, wherein people can come deposit their products. Quality checking agencies are into work which checks the quality of product. These once quality is checked, the products are taken into exchange accredited warehouse. World class warehouses are there which keeps the product quality intact, maintain the quality of product for a long period of time, and they issue warehouse receipts which the depositor can trade on with different participants. They can pledge it with the bank. They can use it as a delivery on the exchange. So a lot of utility comes from the full ecosystem in commodity market. So all exchanges across the globe, they have this provision of giving and taking delivery of products on expiry of contracts. In India, as allowed by regulator, we have 91 commodities in which we can have derivatives. Okay, 91. In bullion side, energy side, metals, agricultural products side, grains, spices, fiber, oil complex, and others. 91 commodities are there. And as of now, we on MCX, we are seventh largest exchange in the world. We only have 14 commodities underlying. So you can see the potential. When we have more 50 commodities as derivatives, this exchange is going to have many multifold growth in terms of participation and volumes on the exchange. So the first segment on the exchange is bullion, wherein we have gold futures. Whatever is in black color is futures. We have gold futures of different sizes and gold options. We have silver futures of different trading units and silver options. We have energy products, crude oil, natural gas with futures and options. We have metals, base metals, aluminum, copper, lead, nickel, zinc in futures and options on copper, nickel, and zinc. We have agricultural products in cotton, crude palm oil, kapas, menthol, and rubber. Only futures are available, as options are not available in agri side. We also have segment indices. Like bullion as a segment, a bullion index, which represents gold and silver, and we have derivatives, bullion index futures, which people are trading on this index. So index derivatives are slightly risk diversified products, smaller products which settle in cash. Like we have a metal index representing aluminum, copper, lead, nickel, zinc, and metal futures are traded on. We have energy index, wherein energy index futures are traded on. Very soon you will find even index options also being launched in the market. For that, the regulator has already given the product guidelines. It is just the approval awaiting, and once we get an approval, we will have index derivatives, futures, and options both available. Now, interesting fact here is on daily basis in Indian markets, equity markets, whatever turnover is happening out of that total turnover, 85% happens on through index FNO, futures and option trade. So this is the area we are entering into, futures and option on indices. And this is a segment index. We have a ready commodity overall market index that would also once be allowed. So it will act as a commodity market reference point, like what we see in Sensex and Nifty as a equity market indicator. That commodity index, overall commodity index, would also indicate what is happening in the commodity markets, and people will trade on its futures and options in times to come. So we have many global factors on which basis the prices are very volatile. It could be international market price, forex rates, geopolitical factors, trade policies and regulation, economic factors, commodity demand and supply scenarios, inventory levels. A lot of them are there. So because of that, there is a price distortion. We know what is the price today, but because of these factors, we don't know where prices can go. There could be a possibility of prices going up or prices going down. So different scenarios could be generated because we don't know what might happen in future. So people who deal with physical products like producers, manufacturers, commodity stakeholders in the value chain. So today, only once they identify their risk and use commodity derivatives to manage their price volatility and risk in times to come. So today only it is imperative to manage risk. So this is another area wherein you all could find opportunities. All corporates and companies dealing with these products, they have treasury department, risk management department who is interested into this hedging activity to manage the risk. So they also require people who understand the markets, who enable making strategies to make them hedge. Many corporates still don't have treasury desk, but they require advisory services from experts who are there in the commodity field to guide them to manage the risk. So this is another an opportunity area. So what is hedging? Hedging in a nutshell means transferring the risk in physical market commodity prices using commodity derivatives. So it is just moving risk in the physical side to the financial markets and then be relaxed. So who all does this physical commodity price risk management? Is people who deal in these physical products like corporates. 91% of the world economic activity managed by corporate, farmers, producers, consumers, merchandisers, importers, exporters. That means anyone and everyone who deal with physical product has this price volatility to be managed, and they use derivatives to transfer risk on the exchange to people who want to take risk. Who wants to take risk on the exchange are people who have nothing to do with physical products. They are people who wants to time the trade, understand the momentum and make money, like speculators, arbitragers, uh, day traders, investors, mutual funds. They want to just time the market, take risk and make profit. So these people, they take risk from the hedgers on the exchange. So who could be a hedger? A value chain. Say for example, gold will have running from mining companies to miners of gold, refiners of gold, international banks dealing in gold, importing and exporting banks, bullion wholesalers across the world, refiners of gold across the world, branded jewelers, unbranded jewelers, jewelry manufacturers, semi-wholesalers, retailers, consumers. That means people in value chain are people who deal with physical gold, and change in the value of gold might impact their profitability. So they all use derivatives to manage risk. So hedging is of two types. I may not go into detail here. I would like to skip this. Now, let us come to a very, very interesting fact. The trades on the exchange, when we do in derivatives, there is something called as daily settlement and final settlement. What is daily settlement? For all the trades in derivatives, you need to have enough margin money in your demat account, so that for every trade, your margin money gets blocked. And once you square off your position, this money gets refunded back. So this online blocking and unblocking, margin payments, refund, reassessment of margins, they are done by the exchange on real-time basis. And if I trade, I can close my position anytime. So if I traded today, I close my position, then profit and loss would have generated on that transaction. So that needs to be transferred to me as a trader in case of profit, and loss has to be debited to me. So all this, on closed position profit and loss, and profit and loss on open position in terms of mark to market marking is done every day at the end of trading hours. You would have heard of this term called as M2M, gain or loss. Okay, so all these markings on daily basis of M2M and assessing of final profit and loss in closed transaction is done on daily basis, and daily settlement happens on T+1. Rule is T+1. What does that mean? For all transaction today, whether you have incurred a loss or profit, gets credited in case of profit, debited in case of loss from your account uh, tomorrow, next day. That is we call as T+1 settlement. Now there is something called as final settlement. All derivatives have an expiry date, so they settle on their expiry time. That is the expiry date. So if there are some contract which says these are cash settled contracts, in that case, the difference between the final settlement price on expiry and the position price is seen, and debit and credit in that case happens. If you make a profit, credit comes to you. In loss, debit happens from your account. These are called as cash settlement. But most of the contracts on the exchange are also delivery based. That means if open positions are there till the expiry and the contract says it will be a delivery contract, so Exchange Clearing Corporation marks randomly delivery to all open positions on expiry, and then buyers are to give the full money, take the delivery of product in their name, and sellers are mandated to give the delivery of the product as per the quality specification on the exchange and receive money. So that is called as settlement by delivery on expiry. So people who deal in these delivery contracts don't want to give or take delivery, have to square off their positions before expiry and roll over their positions to the next contract month. Now, we have futures as well as we have options on the exchange. Options are very versatile products. They are non-linear derivatives. A lot of strategizing on option could be done. In futures, both buyers and sellers, they play for price, and they should have enough margin in their account to trade. Whereas in option, buyer pays the premium money. It's upfront. Margining does not happens to the buyers. Sellers receive the premium. Margining happens to the seller only. So commodity options are also available. Now the interesting part is commodity options are special products in India which are called as options on futures. Equity options, they are options on spot market price. Commodity currency options are also options on the spot product of currency. But commodity options are options on running future contracts. So these are called as derivative on derivative. Okay. So when we talk about option, I'm not going to go in detail. There are concepts like call of put option, option premium, European and American options. So we might, discuss in detail some other time. For your understanding, options are available. And if you understand the option, all these concepts are running. So option on commodity futures are called as option on futures. See, the underlying is a futures contract. That means you can enter and exit, strategize many times in a running option contract from the start till expiry. But on expiry, if you have exercisable open positions, they get converted into the underlying futures contract. Call option gets converted into buying a futures on expiry if they are exercisable. So if participants don't want their positions to get converted on expiry, they can square off their positions. Okay. Now, how this option works is, say, for example, we have a futures contract running, crude oil futures. So there would be a crude oil options on this contract. So crude oil option has the underlying as crude oil futures. So crude oil options will always expire before the crude oil futures contract. Say, for example, this month, 19th of October, crude oil futures will expire and crude oil option will expire 2 days prior to it, because option has an underlying of a futures contract. So if there are open positions and not closed, so on 17th of October at expiry time, all exercisable open positions, they get converted into a crude oil futures contract. This is how options work. Okay. Now, we also have indices. I've told you, we have Bullion index, metal index, energy index. They are representing the underlying products, and these are risk diversified weighted average products. So risk is less. Index futures are already running. Very soon we will have index options once given an approval. So this is where I'm saying markets are developing product wise, and you will see more products coming in, more participation coming in. And when this happens, you'll find more opportunities for yourself. All these indices are made by having weightages assigned to the underlying product. Say, for example, Bullion index, gold and silver index, they have assigned weightages. So these weightages are given by the exchange and they remain same across the year. Okay. So October, this month only, we have already announced that in year 2023, what would be the weightages for these index constituents. Okay. So index trading is the next big thing. You will see a lot of things happening here in the market. Now, very, very important. My second last slide, I would say, when you trade on the commodity derivative screen, or for that matter, any derivative exchange, you need to have these important points in mind. One is you should always trade with the SEBI registered members. Unregistered members can run away with your money. So from where can I get the list of these members? From the SEBI's website, from any of the exchange website. Okay. Very important, give your proper KYC with updated phones and email IDs. Why? Because when you trade on exchange and trades happening in from your money, you need to know all these information. So from exchange side, a lot of alerts, messages, trade updates come. So if your proper KYC is not updated with the exchange, you will not be able to get such messages and information from exchange side, and you may not be able to know what is happening with your money and positions. Okay, till the time client member updates you. So you need to have a proper KYC done. And once you give your KYC documents to your broker, you have to ask them to get them registered on the exchange database. So once that happens, a unique client code is what gets generated for you. That becomes your identity for all the trades. So on all the trades and contracts, this UCC will be mentioned. pay which would have happened by using your money as margin money. So this UCC is very important. Then when you trade on derivatives on any exchange, so there are ingrained product risk to trade. So there is a document of risk disclosure, that what would be the risks associated when you trade in derivatives on a particular market segment on the exchange. So this risk disclosure document is something you should read. Plus, you should also know your right and obligation when you trade in the exchange. So that documents are readily available on all the exchanges on their website. So you should go through them. This is very important. Then what you should not do is, there is nothing called as indicative returns or promised returns. You might be getting calls from some broker saying, sir आप trade करते हैं, आप हमारे साथ trade कीजिए, हम आपको 50% assured return देंगे. Friends, there is nothing called as assured return in market. So if somebody calling you and saying this, he is trying to make fool of you. So you should not fall prey for all such activities and things. There is nothing called as assured return. You should not get attracted to rumors, hot tips, advertisements, which you trade with us, you take advice from us, you will get 100% short returns. So, all these things are, you have to be careful of. Now, what to do in this case? You have to understand the product, its dynamics, demand and supply dynamics, make an analysis of yourself, and then use the product of your choice, whether to use futures or options, and then trade in the market with your understanding, not on somebody else's understanding. All payments on the exchange are to be done in online format. No cash transactions are allowed. Okay. And a very important point, which is mentioned in red, there is something called as dabba trading. Now, dabba trading is an illegal way of trading. It's a book trading mechanism wherein you have to be wary of. This is an illegal way of trading wherein penal provisions are there in case you are caught indulging into dabba trading or doing that dabba trading. So exchange as well as regulators are very vigilant to see that nobody indulges into this kind of a trade. These are off-market transactions done to entice people not to pay, brokerages, not to pay margins, not to pay duties, government duties, stamp duty, and other in the actual general sense to trade on the exchange. So many people fall prey for this. But remember, it's a book trading system wherein the intention of dabba trader is that you as a trader make a loss and they make huge gains out of your money and they might run away. You will not be able to trace them again. So such kind of systems do prevail, but a constant team is there to keep a check. So one should not indulge in all these activities. Now, what could be the probable employment segments for you all? I've already talked on that. Corporate sectors, not only in India, across the world. If you understand the product, you can go and work in their procurement department, sourcing department, marketing department. You can work with their treasury and risk management segment to strategize. You can work with any of the value chain partners. You can work with importers and exporters of products. Say companies like Olam, Louis Dreyfus, Cargill, they are big time traders of physical products. You can work with them, find an opportunity to work there. You can work with banks, you can work with market intermediaries, merchandisers, foreign hedgers. You can work with exchange ecosystem with the exchange, its clearing corporation, its clearing houses. You can work with broking houses, as an analyst, research analyst, what people usually do when they want to be, in the equity market as analysts, senior analysts, researchers, fundamental analysts. So this is what you get, again, an opportunity across the globe. If you learn commodities, you can work with international brokerage houses as well because product remains same. You can work with new market intermediaries. They require people who understand commodity and commodity derivatives, mutual fund, bank subsidiaries. You can work as independent advisory as a strategist and help MSMEs and small segments of industries who don't have expertise in treasury desk to enable them, guiding them how the prices are moved, how they can help them in managing the risk. So that area is also open. Even big fours, PwC, EY, they all have a separate risk advisory department in commodity derivatives. international companies, McKinsey's and all those, they all require people who understand these products. Plus, I told you the infrastructure, back-end infrastructure, wherein delivery, warehousing, quality assaying, many people, if they are interested, that's why there are enormous opportunities to go and work there. As an independent person or faculty or research student on the institutes, you can do a lot of research in commodity areas and submit to the regulator, to the exchanges. Many institutes are doing such independent studies on price behavior, on many aspects related to commodities, and they do research on a continuous basis and submit to us even. Plus, very important, if you understand a product, your employability is not restricted to India, unlike equity market. If you understand gold, you can go and work internationally with any of the 86 exchanges across. You can work with any of the brokerage industries across. You can work with any of the corporate segment across dealing in gold. You can work with mines, miners, you can work with any person involved in this segment using gold. So your ecosystem and opportunities are open in the world economy. Plus, many government agencies who are dealing in physical products, you can get associated and get opportunities of working there as well. So the key is to learn more, to read more, to understand the segment. So you can visit MCX website. There are a lot of newsletters, brochures, manuals, video clips to learn about these areas into depth. So this is where, I leave you by giving this thing in your head is there is no end, no stopping for information to come and analyze. So channelize your energies into, all these areas as well. Learn more about the markets, give certifications of commodities, so that when companies come, so along with equities and currencies, you are well prepared and you have enough opportunities on this side as well. So, and this is a growing market, so opportunities are immense. So this is where I end my session today. And I would be very happy to take any of the queries which you have. Uh, Please go ahead and type messages if you have any. Yes, please. Maybe a question or two, or you can give your feedback for the session on the chat. Please go ahead. We will be very happy to take your queries. Please go ahead. Somebody is asking how to gain practical exposure to these segments. See, Kshitij, you have to first do that homework of reading about these products. Okay, you just follow the price movement, price trends on any of the product of your interest. Data is available on the website, so you can even download the data, analyze the trends. There are websites like investing.com, who have even facility of doing some charting also. So there are ways, whereby you can get data and work on the price trends. But for that, you have to first understand the product. You have to understand, say, for example, I want to understand gold. I read more about that product. What is the historical scenario? What are the current factors which impact the gold prices? What is the current demand and supply areas of gold? And then international exchanges dealing in gold, domestic exchanges dealing in gold. Like this, you develop understanding on fundamental basis. Then you go for technical analysis as well to predict exactly, where the prices could go. Plus, there are many courses done by different institutes to understand and gain more knowledge in this segment. So, I mean, you can find out and enroll yourself for all these things, and they will guide you how to further enhance your knowledge and understand market and analyze market. But the key is you have to start somewhere. Okay. Can you explain FNO again? Futures and options. See, futures are derivatives which are standardized by the exchange. The terms of trade are given by the exchange, approved by the regulator. So in futures, what happens? It's a financial instrument where both buyers and sellers can come and trade on the exchange by paying the adequate margin. This margin is a percentage of the total contract value. Okay, and you can come and trade wherein entry and exit is solely depending on you as a strategist, but you have to take care that when the contract is available to trade and when it is expiring. That is important. But both buyers and sellers are obligated into trade. Whereas in option, what happens? Buyer of the option contracts gets the right to buy or sell. Okay. So that is a different kind of instrument wherein buyer gets the right to either buy or sell by paying premiums. Seller receives the premium and are obligated, so they pay margins as well. Okay. This is how, in a nutshell, I could explain what a futures and option is. Futures is a linear product. Option is a non-linear product. You can do a lot of strategies using, FNO. So maybe I would suggest we can have a separate session on options and futures, maybe sometime later, and we'll explain more in detail. Okay. Somebody's asking, I want to open a demat account. Is there any charges for the same? See, as an exchange, I would say you just find out the right registered participant with whom you would love to go and open a demat account. And what charges they charge depends on them. Generally, they have a very low charge, or sometimes they open without a charge. But you have to inquire on that case from the member. Say, for example, if you want to open with Religare, Share Khan, you have to just ask them. I am sure there would not be any charges. Somebody is asking, Aram is asking, sir, isn't volatility a great concern, and how can one be really secure while prediction on the topic? See, volatility is of concern for people, who are dealing in products. But for products, what I mean is physical products. If prices are very volatile, they get a hit on their options. So yes, it is a great concern. But for the other side of the market participants, where traders are there, so they love to have volatility. Only when prices are moving, are volatile, they get opportunity to enter and exit into derivative trades. So yes, if volatility is less or is adequate, it is okay for both the participants, and it is depending on their nature of behavior, they manage this kind of volatility. So hedgers would like to completely protect themselves by hedging using derivatives, whereas traders in the market, they love volatility to be there, because if volatility is not there, prices will not move swiftly and they will be stuck with their position. So excess volatility is always dangerous for all the participants. But yes, for some people, volatility is boon. For some people, volatility is not a boon. So they manage their participation accordingly. Okay. And how to predict volatility is predicting the prices. So if you able to predict the prices of the products, you can manage the volatility. Okay. Angel 1 in SEBI registered. Shivani, on the face, yes, I know they are registered members, but yes, you just go back and check the details. Yes, they are registered, SEBI registered members. Okay. Somebody is asking, Kushagra is saying, as you know, recession is almost there in India. So how should we invest our money in equity or debt market? Kushagra, see, you have to find out analysis. This is what, you should not follow. If I am telling you, you should go and invest. No. See, what happens in recession, most of the activities, they stop. Okay. And if recession is there, what is the definition of recession? When you have negative growth rate in 3 quarters, continuously, then it is a situation of recession wherein economic activities are slightly down. Equity might give you a negative return, but as of now, we don't see that happening in the equities and debt market in India. Interest rates are going up and markets are performing well. Yes, volatility is there, movement is there, up and down. That is the nature of market. But to understand how to perform into recession, you have to go back to the data, see how in phases, how many times, recession has happened and how asset classes have behaved, how equity has behaved in those recessions, debt has behaved, currency has behaved, equity has behaved, starting of recession, during recession, ending of recession. And then you could pick up some view that how asset classes behave, and then accordingly decide on how to go about making strategies involving what kind of instruments. Okay. Somebody is asking, sir, Angel is one of the safe to invest or not? As an exchange, I cannot comment on that. They are registered brokers, and you have to just pick one of the registered brokers. And if they are registered brokers, I mean, SEBI registered brokers, they would be having the authenticity to trade with. So just, I cannot propagate, you have to open an account with this or this person. Just pick up the list on SEBI registered broker, go and talk to them, see what kinds of brokerages they are offering, what kind of facilities they are offering, and then accordingly you can decide to with whom you have to open your demat account or not. Okay. Any other query pertaining to financial markets or commodity markets in particular? We'll be very happy to take all of them. Please go ahead. In case if there are no queries, can we... thank you for that feedback, Pawan. Can we conclude the session if there are no further queries? Okay, in that case, thank you everyone. Thanks the management, Professor Kamal Gupta and all the professors and students who have taken out their time to understand the market and given us this opportunity to explain this side also as an asset class to all of you. Hope you would have taken a lot of insights into this, but what we touched today was not even a tip of iceberg. It was very small, but opportunities are immense. Keep all the opportunities for yourself career-wise open. It is not always equities or currencies, but definitely look up for the new growth areas. And this is what I've already highlighted. Multifold growth is expected. Next 2 decades, you will see a lot happening in this segment, and rest we leave it to you how you plan your career ahead. But definitely go ahead for certifications which help you getting into good companies and getting good initial opportunities in the market. So this is where I stop my presentation. Anyone would like to add on, please go ahead. Otherwise, we can stop the session.
Thank you very much, sir, for sharing your experience. It has been a really, really pleasurable session. I would now like to invite Dr. Kamal Gupta, sir, to deliver the vote of thanks.
Thank you, Haram. A very good afternoon to all of you. It gives me immense pleasure and pride to propose vote of thanks on behalf of Department of Commerce, Maharaja Agarsen Institute of Name Studies. I am thankful to Mr. Vineet Singh Keller, Senior Manager, Training and Education, Multi-Commodity Exchange of India Limited, for his valuable time and insight on the topic investment awareness. His expertise will definitely help our student in a long way to think about career in finance field. I would also like to thank Mr. Chandranath Pandey, Senior Manager MCX, for their coordination for the whole event and giving us this opportunity to conduct the webinar. My deepest gratitude to Dr. Nand Kishore Garg ji, former Chairman and Chief Advisor MAIMS, for his guiding vision. Thank you for being the catalyst of change for so many of us, sir. My sincere thanks to our Director General, Professor S.K. Garg, MAIMS, Professor G.P. Govind, and our Director, Dr. Rajni Malhotra Dhingra, who have been the pillar of strength and whose advice and compassionate concern for students is remarkable. I also convey to my thanks to Professor Manju Gupta, HOD Department of Commerce, for her continuous support and assistance at all the times. I would like to thank Aram Gupta, our student, for being a great anchor today. I also express my gratitude to all my colleagues and students who have joined the webinars today. I again welcome all our participants to have a great learning experience, and I hope that this webinar student will start working to make career in finance, and they can will take some good certification in this field as suggested by sir. All the very best to you. Thank you and have a nice day.